Welcome to our presentation on how to take advantage of margin accounts. Before we jump into the subject, I'd like to remind you the information provided in this webinar is for information purposes only. The information provided is not intended to provide legal, tax, or accounting advice and does not constitute a recommendation or solicitation of an offer to buy or sell any product. The client is solely responsible for the financial consequences of his investment decisions. On today's agenda, we will look at the different features of a margin account, then show some comparisons and examples to make it easier to understand, some questions and answers, and finally we will review the key takeaways. Let's begin by defining what exactly is a margin account with the following definition. It's an account that allows you to borrow funds from your broker. The amount borrowed is calculated based on the market value of eligible securities already held in your non-registered account. The margin account is very different from a traditional line of credit that you may find in a branch. It does not provide you with a fixed amount that you can borrow or is based on your ability to pay or your credit score. Rather, it is based on what you have in your portfolio. The main advantage of a margin account is leverage. It allows you to have greater exposure to the market by borrowing against the securities you currently hold in the portfolio. There's also the element of flexibility. Basically, you have access to the funds at all times, which allows you to take advantage of market opportunities. You can also use your account as an emergency fund because the use of the margin account is not just for investing. We can do other things with that liquidity. It also allows us to defer capital gains into another fiscal year. Or simply, as we said before, we can use this money to invest in the market. Also, in that case, the interest paid can sometimes be deductible. Apart from the interest charges and the commissions you pay to buy and sell, no other costs apply. Now, the amount of the interest fee is charged pro rata on the amount borrowed and the period of use at the indicated rate. So for an amount used between 0 and 10,000, the rate is 3.85%. Between the amount of 10,000 and 100,000, the rate is 3.75%. If the use exceeds 100,000, the rate applied is 2.75%. The different rate levels stated refer to the use of margin and not the value of the portfolio. I would like to clarify that if you borrow an amount of 105,000, the full amount is charged the interest rate of 2.75%. The interest rate is charged to your account on the 15th of the month for the use of the previous month according to the amount and duration you use the margin. On to the next slide, where we will discuss the list of eligible securities. Previously, we saw that the advance is based on the type of product and the market value. Added to that is risk and liquidity criteria. As for the types of products, here is the list of securities that are eligible to be margined, and at what percentage. Please note, for money market mutual funds, that not all can be margined. The money market fund of the National Bank, as an example, can be margined at 95% because it is essentially composed of government securities such as T-bills. Let's take a closer look at the stock and ETF securities. There are 3 levels of borrowing based on the share price of the security. In the first instance, shares at $5 and above are 70% marginable. Shares between $2 and $5 are 50% marginable, and those under $2 are not marginable. It is important to know that even if the stock is trading at $5 and over, the broker may not offer an advance or an advance of less than 70% on the stock. Concerning the maximum loan amount, or the maximum cash advance, this maximum amount that you can borrow or otherwise the maximum advance your broker is willing to give you varies depending on the type of product and its market value. The value of the transaction on margin is equal to the broker's advance plus the investor's down payment according to the minimum coverage. Let's go ahead with some comparisons and examples in order to illustrate the point. Here we have investor A, who pays his transaction in cash. That is to say that he buys 1,000 shares of ABC Company for $10, and we will have to pay $10,000 for the transaction, assuming no commissions to keep it simple. Now, investor B will make use of the maximum amount of the margin. This means that since the stock is 70% marginable, because the price of the stock is more than $5, the broker will be able to advance $7,000, therefore 70% of the transaction value, which has a total cost of $10,000. This means that the minimum margin coverage for investor B, who uses the margin, will be $3,000 that will need to be deposited. Let's see an example of the required coverage. Keep in mind that the shares of ABC Company are trading at $10. What is the maximum number of shares that each investor can buy with their $10,000 if the shares are marginable at 70%? Investor A deposits $10,000 in their cash account and proceeds to buy shares of ABC Inc. at $10 per share, and 1,000 shares are purchased. Now, Investor B is using margin, and the stock is 70% marginable, and the client has a down payment of $10,000 to buy ABC shares. So Investor B can buy for $33,310. The $10,000 represents the minimum coverage of 30% required by the broker. With this amount, Investor B can buy 3,333 shares of ABC Company. The broker, therefore, lends the investor the other 23,333 to pay for the shares. In our next example, we have Investor A, who made a purchase of 1,000 shares in cash for $10,000 because they did not want to use margin. The shares have now increased to $12. The profit in this scenario, if the client sells, is $2,000, which divided by the $10,000 down payment gives a 20% return. In the case of Investor B, who purchased 1,000 shares on margin, the broker has advanced 70% of the transaction value, so $7,000, and the minimum margin required for the client is 30%, so it's $3,000. The stock also increases to $12, and the profit is also $2,000, but because of the minimum coverage of $3,000 that the investor deposited, the return is 67%. This is a great example to illustrate the use of leverage. Let's take this example a step further with the implications of an increase in the stock price. That means that our shares are now worth $12,000, and by multiplying that amount by 70%, which is the maximum broker's advance, we have a new amount of $8,400. Our new broker's advance minus the previous one, which was $7,000, brings us with an additional $1,400 available to acquire further shares of ABC Inc. if the client wishes to do so. Now, for example 2, let's see what happens when the stock, instead of going up to $12, drops to $8. For Investor A, this represents a loss of $2,000 on an initial investment of $10,000, so a negative 20% return. While for Investor B, who used the maximum advance for the margin, this also represents a loss of $2,000, but on the initial investment of $3,000, so the loss is actually 67%. Now, because of the decrease in the share price, this also has the effect of decreasing the maximum advance of the broker. It was originally $7,000, but the new market value of the portfolio is $8,000, multiplied by 70%, which is the new maximum advance of the broker, which gives us a maximum advance of $5,600. So the initial advance of $7,000 minus the new advance of $5,600 means that our Investor B will have to deposit an additional amount of $1,400 to cover the margin call. For our next slide, let's see how an investor can settle a margin call. There are 3 options available to you. The first is to deposit money into the margin account by doing a bank transfer from your index bank account. You can also sell existing securities held in the portfolio, or deposit or transfer securities from another non-registered portfolio. In order to prevent the investor from going into a margin call at the slightest change in price, a safety cushion or security cushion is required. It represents 30% of the loan value of the largest position in the portfolio. For the next part, I'd like to show you what an example of a margin call on our platform looks like. On this page, you see the following message. At the close of the last trading session, you were in a margin call. Make sure to correct the situation as soon as possible. By clicking on the account, you'll be redirected to the holdings section. Let's take a few moments to browse through this page. Note the total value of the portfolio of $46,560, the purchasing power or the buying power, which is negative $53,276, and where we need to focus our attention on is the margin call of $9,851. In this case, we need to cover the margin call as quickly as possible by using one of the 3 options mentioned on the last slide. The buying power is negative, but the margin call is what needs to be covered. Now let's see how all this information is displayed on your screen when you are transacting on our site. The available margin is the most important element to watch. This number indicates if you're in a margin call. It is calculated during the night, and you will find it in the morning on the summary page of your portfolio. It is calculated with the loan value of the securities plus the cash on hand. For the Canadian margin account, for example, $12,815 is the available margin. $22,943 is the amount of margin being used. If you look further in the page, The maximum borrowing values of each position are shown here. This is where we will find the total loan value, which allows us to calculate the available margin. The total loan value for each security is calculated by multiplying the market value of the position by the broker's maximum lending rate. The total loan value, or the maximum dealer loan, is $35,759. To find out your available margin, we will add the cash to the account, or in this case subtract it, because the client is currently borrowing an amount, and those two numbers will provide the margin available. Note that the negative cash balance here is $22,943 and is the margin currently used in the account. Also, on this page, you can see the security that has the largest borrowing position in order to calculate the security cushion. Now, by clicking on the buying power, you will be able to see the details of how the calculation is made. In the account shown here, the margin used is $22,943. There is no current monetary transfer coming from a bank in progress. The value of the loan as seen on the previous page is $35,759. You have to remove $3,500 from the margin for the security cushion, which is an adjustment for concentration. And this gives us a buying power of $9,315 for this account. Let's move on to some questions. What is the maximum amount an investor can withdraw from their margin account? Is it A, the available margin, B, the buying power, or C, the cash on hand? Second question, if the buying power was $2,500, how many shares could the investor buy at $10 per share and the stock being margined at 70%? The answer to the first question, what is the maximum amount an investor can withdraw? The buying power. For the second question, the customer has $2,500 and wants to use the margin at the maximum level of 70%, while the share price is $10. How many shares can be bought? Basically, our $2,500 represents our 30% down payment, or the minimum coverage. That is to say, $2,500 divided by 0.30. That gives us $8,333. And since the stock is trading at $10, we can buy 833 shares. And the broker's advance will be $5,833 at that time. Now, the key takeaways from this webinar are: the buying power is marginable. The more an investor invests in a particular security, the higher the security cushion will be. One can increase one's buying power by selling, depositing cash or securities that are marginable. Our next slide shows the eligibility criteria for the margin account when you apply. You require an annual income of $35,000, a net worth of $10,000, a credit bureau meeting the criteria of National Bank Direct Brokerage, and finally, assets at National Bank Direct Brokerage of at least $5,000. What type of investor will a margin account appeal to? An investor who has a good risk tolerance, good knowledge of the markets, and someone who is financially at ease. If you want to proceed and open a margin account or convert your cash account to a margin account with National Bank Direct Brokerage, we offer 3 ways to open an account with us. You can do it online, it's easy and convenient, and it's the fastest method using the nbdb.ca website. By telephone by calling us at 1-800-363-3511 or at the National Bank branch nearest to you. Each financial advisor is able to process your request. If you have any questions, please contact our customer service at 1-800-363-3511. Thank you for your participation.